Hey guys, Jack here and welcome back to the channel. Today we'll be discussing why your strategy is not working, or perhaps a better way to say it, why 95% of traders are losing money, suggesting all of their strategies also don't work. Without further ado, let's get into today's video. No matter if you're new to trading or an experienced professional, everyone should have heard about backtesting. Also, whether you're using TradingView, Forex Tester, the MT4 bar by bar feature, or NinjaTrader, everyone, and I mean everyone, should be doing backtesting if they want to be a consistently profitable trader. This is why when I'm speaking to anyone who is struggling or is an unprofitable trader, the first thing that springs to mind is whether they've done backtesting. And what do you think the usual answer is? 99% of the time, it's a pretty fast no. So you may be asking, why should you be doing backtesting? Well, backtesting has many benefits. These include seeing if your strategy has a positive expectancy and whether you have a statistical edge in the market, increasing your confidence in a trading strategy to improve your trading psychology, spotting trends and ideas that you could use to improve your trading strategy, and the best of all, you can emulate your trading strategy without putting any actual live capital, which is essentially money, at risk. The best metaphor I can use for why you should be doing backtesting is this. Trainee pilots always learn to fly on a flight simulator before they can go anywhere near flying a plane in real life. This means they can learn from their mistakes, up their skill level and improve until a point where the risks are minimised, or without actually putting anything at risk. So applying this exact logic to trading, you can see why it's advantageous to utilise backtesting as your simulator before heading into the live markets. Another idea of why your strategy is not working is that your trading system is incredibly discretionary and you've not been trading long enough to build your trading intuition. If you're a beginner watching this and you use the fabled break and retest strategy, this is being directed at you. All jokes aside, strategies like break and retest, Fibonacci retracements and trendline breaks are usually too discretionary to be successful. Now, I'm not saying that all these technical analysis tools are useless. I know some incredibly successful traders that trade very discretionary strategies that they've developed over many years. I am simply suggesting that bringing slightly more mechanical aspects to support the discretionary system will highly benefit your trading, especially as a beginner or an intermediate. Let's head out to TradingView and I'll show you what I mean. So guys, here we are on JPY and we're going to use a Fibonacci retracement tool. For those of you that don't know, the theory behind using a Fibonacci retracement tool is to capitalise on a pullback of an established trend, just like the one we can see here. As you can see, we start from this low, up to the high, followed by a pullback, and then another move to the upside. If we then get our Fibonacci retracement tool, I personally go from the bodies on the intraday time frames and put our Fibonacci retracement tool. We can see how price has interacted with quite a few levels here, especially the 50% over here, 38%, and the 61.8 down here. This then leads us on to the main issue with using the Fibonacci retracement tool. They're extremely easy to implement in hindsight, but in real time it's actually quite hard to implement them into a profitable trading system. If we look at some positions that we could have taken using this Fibonacci retracement, we can get our long position tool and we could have entered on this 38.2 rejection. There's some good long wicks and we could have got a really solid position, but as you can see, we would have gone on to hit stop loss unless we had a very wide stop loss, in which case we'd probably struggle to satisfy any sort of minimum risk reward criteria. The next position could have been this 61.8, and again this would have been a profitable position, and providing our stops are wide enough, which in this case they probably could be, we would be able to get a satisfactory risk reward ratio of say 1 or 2. There is a way to combat this by introducing a more mechanical method into your trading strategy when using the Fibonacci tool. This could be by using only 1 or 2 levels on the Fibonacci retracement tool instead of just randomly looking for any level that price interacts with. You should also have defined criteria from whether you mark your fib on swing high points and swing low points, and whether that's the wicks or the bodies. For me personally, on the intraday time frames, so that's anything below the daily, I will always go from the bodies, and on any higher time frames, I'll always go from the wicks. That way I know I'm always staying consistent. Next, we have an incredibly important idea. A trading strategy should be based upon sound logic and have relevant theory behind it to back the trading system up. For example, most indices appreciate over a long period of time. Therefore, planning to sell the FTSE 100 and hold short for 5 years is likely to be a flawed idea. Another example is employing an oscillator such as the RSI to pick reversal on the 5-minute chart on USD CHF, which has actually been in a downtrend for the past month. How many times do you think the RSI has entered the oversold area on the 5-minute chart over the past 30 days? My money would be quite a lot rather than never. Let's now flip this on its head and consider it from the opposite perspective. We know the FTSE is likely to go up over a long period of time, so opening a buyer position and holding for a longer term period has some sound theory and logic behind it. The last suggestion we'll speak about today is not following your trading strategy's guidelines, which can happen for any number of reasons. Perhaps you haven't actually made a trading plan and therefore you've not actually written down your strategy rules, so you're not entering the same setup at all. Another common pitfall for beginners is allowing their poor trading psychology to impact on their application of their trading strategy, causing its performance to be hampered. Although much harder to rectify, I would probably suggest reading books by someone like Mark Douglas or Brett Steenbarger on trading psychology, because this is a really good place to start, especially when you're just a beginner. Finally, not entering all trades that satisfy your trading strategy's rules is another common mistake that beginners make. When you are first starting out, the best way to proceed is to take every trade that your strategy suggests, and then analyse your backtesting and live testing journals to improve your trading system. The point to remember here is that you should not view yourself as a trader. Instead, it's better to focus on the fact that you're merely pressing buttons based on what your trading system tells you to do in order to be profitable over the longer period of time. To end this video, I will leave you with a quote that I thought summarised this all very aptly. One day, years from now, a trading desk will typically consist of 3 things: a man, a dog, and a computer. The computer's job will be to trade, the man's job will be to feed the dog, and the dog's job will be to bite the man if he goes anywhere near the computer. With that in mind, guys, thanks for watching and I will see you in the next one.